Welcome to Fun with Annuities with your host, me, Stan the Annuity Man, America's annuity agent. Can annuities be fun? Can contractual guarantees be fun? Absolutely they can. Find out the brutal facts about annuities with no sales pitches or high-pressure nonsense. Just the brutal and factual annuity truth, which is all you need to hear. Let's have some fun with annuities, and let's have that fun start right now. Hey, this is Stan the Annuity Man, and welcome to Fun with Annuities. Today's topic is a fun one. It's called Unique Annuity Strategies that Contractually Work. And what we're going to do is, there's some straightforward strategies for annuities that solve for, principal protection, income for life, legacy, and long-term care. That acronym is PIL that I always use. And then I always use two questions that what do you want the money to contractually do, and when do you want those contractual guarantees to start? But from those two foundations, from the PIL and then those two questions, there are some strategies that I have developed and I have tweaked some of the older ones to my liking that are contractual, but also solve for what you're trying to do. Because remember, annuities are math. I'm a math geek. They're contracts, and you own them for what they will do, not what they might do. Will do is the contractual guarantees. The might do is all of the other stuff you hear, which is too good to be true, hypothetical, theoretical, back-tested, projected, hopeful scenarios. Never buy an annuity for that. Understand that annuities can be held inside of IRAs, inside of Roth IRAs, and non-IRAs. So with all of the strategies we're talking about, we can design them for wherever the money is located. And if it doesn't work in those, I'll tell you. So I'll be very straightforward. And hopefully, after you hear this, it'll tweak your interest on, hey, I've got the situation, and you'll contact me, either shoot me an email. My email is stan@theannuityman.com, or you can go to my site, theannuityman.com, and schedule a call with me, and we can discuss it. And I can tell you if we can either do it, I'll start running quotes, and you'll find I'll treat you as a professional, and I won't bug you. I'll just give you good information. If you don't have my books, I'll send you my book. So let's talk about, I think I've got 6 or 7 I kind of want to talk to you about. The first one I call the legacy income monster. Legacy meaning you're going to leave money to your kids or grandkids or friends or whoever. And the best legacy product on the planet is life insurance. I don't sell life insurance, but it's still the best legacy product on the planet because it leaves a lump sum to the listed beneficiaries, tax-free, probate-free, lump sum. I always tell people life insurance is the best return on investment you will never see because you're dead. But, Stan the Annuity Man has tons of life insurance on myself that will take care of my family in case something happens. But with annuities, everything is guaranteed issue. So you don't have to go through any testing, blood testing, medical records. Everything's guaranteed issue. So how to use legacy for annuities? One way is there's what's called death benefit riders that you can attach to just a deferred annuity, and it'll grow and leave money to your beneficiaries. Unfortunately, it's not tax-free like life insurance, but if you can't qualify for it, that's the way to do it. But the legacy income monster thing that I've come up with, strategy, is taking, the father, grandfather, great-grandfather, and then running a joint life quote with their child, grandchildren, whatever. So I just recently did one. The person was in their 80s, and their great-grandson was, 2 or 3 years old. So it's a joint lifetime income payment. So obviously, the basis for the pricing of that lifetime income stream is based on the younger, the 2-year-old, right? So that was pretty cool to see that payment. And then he attached a cost of living adjustment rider to that, which increased the income. Some carriers will allow you to do, some won't, but he did that. So what's the legacy of the legacy income monster when grandfather dies? Well, the income stream continues uninterrupted and unchanged for the life of the grandchild monthly. He set it up monthly. You can set it monthly, quarterly, semi-annually, annually. So it's going to continue for the life of that grandchild and increase annually. The number we ran out just to show contractually what it would be if the grandchild lived to their life expectancy was just ridiculous. So as I always say, your kids are going to show up to your funeral in a Ferrari anyway. So why not have them be making payments, right? So a lot of you are chuckling out there. but it's true. I mean, sometimes you want to do what I call handcuffing the beneficiaries. And handcuffing the beneficiaries is really a love strategy. You love them to death, but you don't want them to make mistakes. And you do want them to have an income stream. So a legacy income monster, and we can run it a couple ways. We could run it with income starting now or income starting at a future date. Income starting now would be an immediate annuity, a single premium immediate annuity. Income starting later would be a deferred income annuity. So put that in the back of your head. That might be something you want to look at and have me quote. Second thing I want to talk about is what I call annuity arbitrage. And annuity arbitrage sounds really cool. I know you're saying, man, that sounds cool. It's really pretty basic. In essence, what you're doing is you are buying a single premium immediate annuity that pays you for life. It's a life only, meaning that when your Learjet hits the mountain and you die, money goes poof. And you say, well, Stan, why would I want to do that? Well, the part of the arbitrage is the annuity income stream coming from that immediate annuity is paying the premium on a life insurance policy. So at the time you buy, the way the process would work, and I would put you in touch with someone who I trust to sell you life insurance in the right kind of like level term, not some highly expensive stuff, just a very good, the highest death benefit for least amount of money, level term type product. Let's just say, all right, I want to leave my family $3 million. So we'll find out what a $3 million death benefit would be, okay, for you. You would qualify for that, find out what the annual premium would be, and then we would run an immediate annuity quote, reverse engineer it to solve for the amount of money to pay that annual premium of the life insurance policy. So the way the annuity arbitrage works is that the immediate annuity income stream funds the life insurance policy premium so that when you die, the immediate annuity goes poof, right? Because it's life only, but your beneficiaries get tax-free lump sum the life insurance. So annuity arbitrage is another one you kind of want to put in the back of your head. Would love to quote that for you. That's one of my favorites because I think it's a leveraged way to contractually do legacy. And you could also do it to where, hey, I need income too, so half of the income stream goes to you and the other half goes to fund the life insurance policy. Or you could do it joint with your spouse and you could do it the same way. There's myriads of ways to do it. Just understand that the immediate annuity income from that, either all or part, funds a life insurance policy. So annuity arbitrage. The other one that kind of leads into the next one, which is what I call leveraged legacy doubler. And the leveraged legacy doubler is kind of what I was talking about in the annuity arbitrage, which is you're married or you have a significant other partner. You run a joint lifetime income stream for, both you and your partner, spouse, wife, whatever. And you can run it to where all of the immediate annuity income funds a life insurance policy, or like I said before, that a portion does and you keep some for income and the other, funds the life insurance. But this happens a lot. Like I just did one recently, husband and wife, and they needed like $1,000 worth of income a month for both of them. But he also wanted to set something up. So when he died, which males typically pass away before females, he wanted to make sure that she also got a lump sum. So, it was like a $3,000 a month income stream. $1,000 they were using as joint, right? And then the other $2,000 was funding the life insurance policy. So what would happen is under the leverage legacy doubler, when he passes, the life insurance policy, because it's on him and him only, gets paid out lump sum, tax-free, probate-free to his wife, but the income stream from the immediate annuity continues for her life. So she's somewhat double dipping. So instead of, just keeping $1,000 a month because they were taking the other two and funding the life insurance policy, she continues to get $3,000 a month and gets the lump sum from the life insurance. So I'm hoping, I'm going to continue to give you some more, but I'm hoping what I'm doing is planting seeds in the back of your head that there's more to this, that people like me that are kind of math geeks out here that are always thinking about, okay, if we're going to do contractual guarantees only, how can we leverage contractual guarantees with contractual guarantees? There's ways to do it. So that's leverage legacy strategy for typically, you and your wife, you and your spouse, you and your partner. So the other one that is kind of an old school one is called a split annuity strategy. In low interest rate environments, it's not used as much. But the way it really works is that you would come to me and say, I need X amount of income starting immediately, but I only have a certain amount of money total that I can apply to annuities. how do we maximize it? And typically what we do, and if you look at split annuity, what split annuity means, we're buying multiple annuities at the same time to solve for different things. So in essence, a basic split annuity strategy would be to buy an immediate annuity that pays, say, for 5 to 7 years, okay? And after the 5 to 7 years, money goes poof. But the second annuity you bought would be like a multi-year guarantee annuity, a fixed rate annuity for a 7-year time period. After that 7 years, you annuitize it to pay for another specific period of time. And then after that specific period of time is gone, the third annuity that you buy with the other two at the same time is a deferred income annuity or an income rider that has income starting at that final date. So, annuity number one, the immediate annuity goes for, let's just say 7 years as an example. The MIGA that you buy defers for 7 years. After the 7-year time period, you annuitize it, create a lifetime income stream. And let's just say that goes for 5 years. And then the annuity you bought for the deferred part, the income rider or the deferred income annuity, defers for 12 years. So after the first two are gone, you turn on the third one that's been deferring for 12 years and continue that income stream. We can design it so that to hit a number contractually. So if you say we need X amount per month, starting now, and here's the amount of money, we can show you what it will take to do it with a split annuity strategy. But what it does, it just solves for income now with a specific, consistent income contractual strategy that is used long term. It's really cool if we have the numbers exactly contractually right to what you're going to do. There's no hypotheticals or theoreticals. It's going to happen. But, split annuity strategy, been around a long time. People kind of put names on it, but that's what it is. The other things I do kind of unique, laddering for principal protection. A lot of people don't need income. They just want to protect the principal and just get a yield. Multi-year guarantee annuities are fixed rate annuities. It's the annuity industry's version of a CD. So if you go to my site, theannuityman.com, stantheannuityman.com, either or gets you there, you can pull up a live feed of the best MIGA rates in the country based upon your state. So when you pull it up, you'll see 2 questions, state of residence, you click that, and then duration. So a typical fixed rate ladder would be you buy a 3-year duration, a 4-year duration, a 5-year duration, a 7-year duration. Let's just say that. So what happens, you have money coming due in year 3, and then after that 4, and then after that 5, and then after that 7, and then you just keep rolling it, because whether it's an IRA that you have these in or a non-IRA asset, you can transfer tax deferred. If let's just say it's a non-IRA asset and you have this ladder in there, when one of these MIGAs mature, obviously you can get your money back and we'll send you a check if that's what you want. But you also have the choice of rolling that to another MIGA, another fixed rate annuity, under IRS approved 1035 rule. 1035 is the section of the IRS code that says you can transfer an annuity to another annuity without any tax consequences. So if you have that ladder, as soon as one's coming due, then we'll roll it to another to continue the ladder, and you continue deferring interest. The difference between a MIGA and a CD is with a CD and a non-IRA account, you have to pay taxes on the interest every year. With a MIGA, multi-year guarantee annuity, fixed rate annuity, that interest compounds tax deferred. Now, once you take it out, you have to pay taxes on it, but if you just want to protect the principal, not pay taxes and defer the taxes, and it's a good strategy. The other way to do principal protection with contractual yield is what I call a mixed fixed ladder. There's 2 products that solve for principal protection. One's a MIGA, multi-year guarantee annuity, fixed rate annuity like a CD. The other is an indexed annuity, a fixed index annuity, not without any riders. If you buy a fixed indexed annuity without riders, there's no annual fees. It's a very efficient product. The difference is there's no guarantees other than you're not going to lose money. There's a limitation on an index call option, typically the S&P 500. But indexed annuities, fixed index annuities, whatever you want to call them, were designed in 1995 to compete with CD returns. In essence, they're enhanced CD products. So the hope is you're going to get maybe 50 basis points up to 100 basis points more in yield if the markets go in your favor, with the understanding you're not going to lose a penny. So a mixed fixed ladder might be a 3-year MIGA, a 4-year MIGA, a 5-year MIGA, and then a 7-year fixed indexed annuity. Or you could do, a 3-year MIGA, a 4-year MIGA, a 5-year fixed index annuity, and a 7-year indexed annuity. We can split it up a myriad of ways, but that way you would have the MIGAs, what the percentage is going to be, and then the fixed index, that you're not going to lose a penny, but you also know there is a possibility you're going to get a little bit better than a CD return, because that's what they were designed for in 1995. So that's laddering for principal protection, fixed rate ladder and mixed fixed ladder. Now, staying in the laddering category, you can also ladder for income, what I call a lifetime ladder, which is a lifetime ladder is purchasing immediate annuities over time. Give you an example. If someone says, I have $500,000 that I want to put in immediate annuities, but I don't need all the income right now, then we would buy, 100,000 this year, and then for the following 4 years, so 100,000 for 5 consecutive years, going out and quoting for the best immediate annuity guarantees over that 5-year time period. That's what I call a lifetime ladder. And you could also do what's called a target date stair step ladder, which is what I call something where we're buying annuities at the same time, but each one of those has a different start date, income start date. So that could be a combination of deferred income annuities, which are called DIAs, or income riders, which are typically attached to indexed annuities. And once we attach an income rider to an indexed annuity, we're not looking at the accumulation value. We're only looking at the guarantee of the income rider. It's a delivery system for that income guarantee. So target date stair step, you might say, okay, I want income starting in 5, 7, 10, 12, and 15 years. Okay. What we'll do is we'll quote every single one of those parameters. And whatever has the highest contractual guarantee, that's probably what we're going to go with. But it's hopefully going to be a combination of both deferred income annuities, DIAs, and income riders. That's a target date stair step ladder. People say, oh, how do you combat inflation? How do you go about combating that? There's only one way, is to have income starting at different time intervals. Agents and advisors will tell you they have the annuity that will address inflation. They do not. Okay, there's just no way to price that contractually. So the best way to rationally go about it with an IQ, right? We do everything for will-do standpoint, is to have income starting at different intervals. So that's a target date stair-step ladder. Last one I kind of want to cover, and once again, if you have an idea, we can go do it. I've pretty much done everything out here, top agent out here, licensed in 50 states. COLA inflation ladder, which is kind of the same thought as the target date, but what we do is we're buying immediate annuities and deferred income annuities, which are in essence the same product. It just comes down to when you're deferring, and we're attaching cost of living increases to each one or every other one. Now, cost of living adjustment increases or CPI-U increases, just to let you know and to repeat myself a little bit, annuity companies don't give anything away. When you attach any type of increase to an income stream, the annuity company is going to lower that initial payment when compared to the same exact annuity quote that does not have that increase. But a lot of people say, hey, Stan, I want to increase. Fine. We'll do an immediate annuity with the 2% COLA. Then we'll buy a deferred income annuity that starts in 3 years with the 3% COLA. And then we'll do another deferred income annuity that starts in 5 years with a 4% COLA. Just giving an example. And all of those contractually will increase, and all of this stuff can be set up single or joint. We can set it up so that 100% of any unused money goes to the beneficiaries. Remember, all of this is customizable. You just have to say, Stan, this is how I want the money to work contractually. This is what I want the money to do when I die. I will design it contractually to achieve exactly what you want. So we talked about legacy income monster. We talked about annuity arbitrage, leverage legacy strategy with the wife. We talked about split annuity strategy. Some people call them buckets, the bucket strategy. We've talked about laddering for principal protection, the mixed fixed and the mixed and the fixed rate ladder, and then laddering for income. Last thing is what I call kind of the IRA mirror strategy, which is a little quirky just because you need the same amount of money in an IRA and in a non-IRA account to make it work. And a lot of people don't have that. Most people have just a lot of money in the IRA. So let's give you an example. If you have $500,000 and this is probably a large amount, but let's just do it anyway. $500,000 in your IRA and $500,000 in a non-IRA account. You can put death benefit riders on both of them. Okay. and take out the RMDs from the IRA, whatever that is, and then take out the exact same amount from your non-qualified that doesn't need RMDs, and you're taking that amount and that's income, right? What happens when you do that is the death benefit continues to grow, even though you're taking it out, it's kind of being offset, but it continues to grow. So it's a way to solve the RMDs for that specific amount of dollars asset in your IRA, get an income from both annuities, and when you die, be guaranteed that the money has been growing and you're going to leave more money to the beneficiaries than when you started. Now, there's a lot of carriers. I used to do this a lot, and a lot of them have stopped offering a lot of the death benefit riders, but there's a few out there that we could do. But the reason I even throw that in there is that I want to push you to think about what you really want the money to do. And this drives the point home of annuities or contracts. So in essence, what you're asking me is, hey, Stan, here's what I want to happen to the money while I'm living and while I'm dead. This is how I want to structure it, either on me or me and a spouse and partner or me and a kid, whatever. This is what I want to do. Am I dreaming? Is there something out there, or can you custom design something that works and achieves all of my goals? Well, you should know by now I'm going to shoot it straight. And I'm going to tell you if we can or we can't. And if we can, I'm going to run those quotes for you. And as always, I'm going to treat you as a professional, provide all the information needed, give you the best quotes out there, send you my books, and then leave you alone to make a decision on your own terms. You obviously can contact me anytime, but that's the way the process works. So hopefully this podcast has kind of opened your eyes to the possibilities, not just the package product that you're hearing at the Bad Chicken Dinner seminar, but maybe it's something that's very unique to your situation that I've either designed in the past or that we can design for you based solely on contractual guarantees. And with that, I appreciate you listening to Fun with Annuities. See you next time. Thanks for listening to Fun with Annuities. Please hit the subscribe button and make sure to go to my site at theannuityman.com, where you can run your own SPIA, DIA, and QLAC quotes and see a live feed of the best MIGA fixed rates in the country, and even get indexed and income rider quotes as well. You can also sign up for my 6 Annuity Owner's Manual books, and I'll ship them for free and under no obligation. I also encourage you to schedule a one-on-one call with me, Stan the Annuity Man, so we can have a full discussion of your specific situation. It will be the best brutally factual and truthful advice you will ever get, and that's one guarantee you should definitely take advantage of. So join me next time for the #1 annuity podcast on the planet, Fun with Annuities.